Hello and welcome to the Hotel Investors Marketplace produced by Hotel Brokers International. I'm Charlie Fritsch, President of HBI. The Hotel Investors Marketplace is designed to provide the most current information in franchising, lending, and valuation, as well as provide an opportunity to preview recently listed hotels. While everyone gets signed in and comfortable, we'll highlight a few HBI member listings on the screen. You can watch for those. They'll move quick, but you can go to hbihotels.com for more info. And I'll take this opportunity to share a few items. Hotel Brokers International is a leading hotel sales organization with more than 50 hotel brokerage specialists. Founded in 1959, the organization's broker professionals have successfully negotiated more than 10,000 hotel real estate transactions and annually account for 48% of all mid-market and economy hotel sales in the United States. Visit HBI on the web at www.hbihotels.com. If at any time during the webcast you have a question, just click on the Ask a Question button found on the gray bar located at the top of the webcast player. Type in your question and submit it. We'll answer as many as our time allows. Please let us know how we're doing. Rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player at the end of the webcast. Later today, this webcast will be posted to the HBI website at www.hbihotels.com for on-demand viewing. Now, it's my pleasure to welcome Jeff Higley, Vice President, Digital Media and Communications for HotelNewsNow.com, Smith Travel Research, and Smith Travel Research Global. Jeff, welcome.
Thanks, Charlie. Appreciate it. Thanks for having me again. I always enjoy doing these webinars and appreciate the invitation. So welcome to everybody on board. Hope the week is going well for you. A lot of good news in the hotel industry that we'll go over throughout the next, 60 to 90 minutes. Charlie asked me to give a little bit more background on myself and what I do. So I've been working with Smith Travel Research, STR, for the past 5.5 years. We launched Hotel News Now in our anniversary. Our 5-year anniversary is actually coming up next Tuesday on September 17th. So we launched our website. Oh, thank you. We launched our website 2 days after Lehman Brothers collapsed. So we knew exactly the right timing for that. And
right.
It's been an interesting ride for the last 5 years, but we certainly feel like we've made an impact in the industry in presenting up-to-date and current events as they happen in the hotel industry, just like today with the announcement that Hilton Worldwide had filed its long-anticipated IPO, and that process has begun. So we'll talk a little bit more about that later. Of course, Hotel News Now is a division of STR, which is based in Hendersonville, Tennessee, located just outside of Nashville. We have STR Global offices located in London. We also have offices located throughout the world. Worldwide, STR and STR Global both combined have about 6.3 million rooms that we track data for. So it's a good representation of global, and that number is getting stronger. The STR Global office and company was founded in 2008, just before, or just actually right when I was joining the company. So it's been fantastic to see that arm grow to representing more than 2 million rooms worldwide in its portfolio, coupled with the 4 million that STR keeps track of. So it's been a good run, and we still have a ways to go to quote conquer the world, but the great efforts by the STR Global staff and the STR staff in Tennessee, we continue to build that census database and the pipeline database of projects under development.
Well, that's great. I know that anybody that does international transactions outside the U.S. is happy to see you making progress and getting more hotels and getting the data in more markets internationally, because you know, it's been something that's been missing. So glad to see you active globally, and hope that spreads throughout the world.
Well, you know, as you know, the ratio of branded or franchise properties in the U.S. is about 75% or so are branded. Worldwide, it's just the opposite. About 25% of them are branded. So, you know, with a lot more independent properties to tackle independent, it's been it's been a brisk pace, but it's been a very calculated pace, as you can imagine. There are markets that are heavily dominated by independents that we're continuing to make headway in.
And you have to approach them one at a time versus the chains you can get all together.
That's right. So, you know, hopefully 5 years from now, when we're celebrating our 10th anniversary for STR Global and Hotel News Now, that, you know, we'll be up to 4 or 5 million rooms outside the United States, which would be quite an accomplishment. You know, we talked to a lot of people and internally, externally, trying to get that grasp on just how many hotel rooms are there in the world. And, you know, depending on who you talk to, it ranges from 17 million to 22 million, depending on your definition of a hotel room. You know, is a hostel included, all that kind of stuff. So we don't have an official number that we put out there as a total number of hotel rooms in the world. But in general, I like to say that it's around, I think we've kind of determined that it's around 18 million hotel rooms as we know them, you know, up to Western standards. So so there's still a lot.
And that's usually for properties with more than 15 keys.
That's right. That's right. That's kind of where our cutoff point, particularly in international markets where you get those smaller independent properties involved. That 15 key mark is a magic number that kind of makes it more of a hotel environment as opposed to a B&B.
Right. Yeah.
So, you know, I'm happy to answer any more questions about STR or Hotel News Now. I guess I'll give a little bit of more background around that. I know you guys know us well. We partner on several projects. Hotel News Now, we attract about 140,000 visitors a month to our site. And we are almost ready to crack the 12,000 barrier in terms of number of articles on the site. So in 5 years, that's a pretty good pace. We've got 8 editors, including one we just hired that is officed in the STR Global office in London. So we have our first international editor to tackle getting more news from the UK and Europe proper to enhance our editorial offering. As Europe's starting to come out of its funk a little bit from the Great Recession, you know, we think it's a great time to have someone there monitoring the growth of the hotel industry there. So we're really excited about that.
Yeah, that's great. Good. And so you've got data for us mostly on the U.S. market, I think, today.
Yeah, I've included a little bit of global, but because I think most of the people tuned in are more domestic oriented, we've really focused on the domestic market. So as you can see, the U.S. hotel industry, the performance turns on. We've had really a great run the last 3 years. We'll have some numbers here with record demand, a lot of records being set. It's just a good time to be in the hotel industry. The big question that always remains is, where is rate going? Why hasn't it been more aggressively addressed by hotel owners? And then, of course, for your audience, a lot of them, where's the money? And what's the pipeline look like, and what's the transactions look like? So I have some slides that talk a little bit about that with our Hotel Transaction Almanac, which, of course, we partner with HBI on. So we're really thrilled to have that relationship and be able to share some of those numbers.
Yeah, well, we're happy to be working with Smith Travel Research and Hotel News Now, and glad that, all these are key issues. So sounds interesting. Let's get into it.
All right. Well, let's get it rolling then. You can see what the agenda is here. I won't go over every one, but there's a pretty good array of topics. So as Charlie said, if you have any questions, let them know, and I'll be happy to answer what I can. I do like the kid, kind of, that I'm just a pretty face, and if I don't know the answer, I'll get the answer. So if it's something I can't answer, we'll certainly I'll find somebody at the STR offices that can and get back to you. So you can find this presentation after the webinar on the Hotel News Now website in the data presentation site. You do need to be a registered user. It's free, but we do like to keep track of who's viewing the registrations, or pardon me, the presentations. So if you're not a registered member, we don't sell that list unless you opt in to receive messages from our partners. So if you opt out of that, you'll never get an advertisement from us. So
good to know.
So there we go. Here we go. So what I'm hearing, this is really the most understated recovery ever. I think most of the people I talk to are very optimistic about what's going on in the hotel industry, yet they kind of look over their shoulder waiting for the boogeyman to jump out of the bushes or the other shoe to drop, because it's been too good for too long, and at what point does something happen that's completely out of the hotel industry's control, but yet greatly affects it? And I think the Lehman Brothers collapse 5 years ago is a perfect example of that, because you can remember what were the residual effects of that. We had the AIG effect from the St. Regis out in California, and the whole crumbling, if you will, of the luxury aura, and all of a sudden 5 years ago, October-ish, all those luxury hotels were being put on 60 Minutes and all of the news shows about how can they charge this amount? That's ridiculous.
Right.
But none of those shows were asking about how they could charge the amount they were charging for commercials or their business model.
Right.
So
right.
it was kind of interesting that it got thrown out there. But
and one of the biggest factors for us, at least in hotel transactions, was pretty much the collapse of the capital markets or near collapse, and the virtual collapse of financing for hotels. We were getting deals done, but far fewer. I know that the hotel transaction volume right after the 2008 for a year or two, it was down as much as 80% in transaction volume. So it was a huge hit, which the industry couldn't control. And so I guess everybody is still looking over their shoulder and hoping something external like that isn't going to happen again.
That's right. It's still there's still a hangover from that in the industry today in terms of available money. There's a lot of there is money available, but when you have to start getting into guarantees and things of that nature, it does kind of limit the scope of what you can acquire, what you can build, so to that regard, that what happened 5 years ago is still being felt today.
Definitely.
So overall, group business still lags. I'll show you some data about that. There's mixed feelings about where it is heading. We had our hotel data conference in Nashville last week, and Tim Hart from TravelClick said that the end of this year looks like group business. There's a little bit of an uptick. It's pacing ahead of where it was last year. But in general, the general feeling is, and I think Mitch Shaw from Noble Investment Group said that he expects the new dynamic of group business to be a permanent new model, that group business will never reach what it did pre-recession. So that will be interesting to watch. The next point is one that I'm certain your members are well aware of and deal with on a regular basis, with the mandated renovations, i.e. PIPs, causing friction between brands, owners. it's not causing an abnormal number of conversions, but anecdotally, I have definitely heard from HBI members and others that it is one of the culprits for the slowed transaction environment. You get to a point where does it make sense to pay this price plus a PIP? And how does that affect your cap rate? And maybe it does. Maybe your numbers don't work when your PIP is included with that. And the brands are being very aggressive in their PIPs, as everyone well knows, because it's been a while since a lot of properties have been renovated, and they need to get them up to speed quickly. So it's
right. And as time passes, the brands institute new standards, and then if they haven't enforced them for the seller, they're going to enforce them for the buyer.
That's right. Somebody's got to do it. And I think the buyer and seller are doing that like Laurel and Hardy thing where pointing at each other going, you do it. No, you do it.
Right.
So it'll be interesting to see how long that lasts. But we know there's still a lot of properties that have not yet been renovated and PIP'd. So we think that's definitely something that we'll continue to watch. Meta search is the name of the game for OTAs. OTAs are still a very big part of this business, even though some of their earnings have declined in recent quarters. Where does Google come into play with all of this, with their hotel finder feature? We had the speaker, Rob Torres from Google, the head of Google Travel, at the data conference, and it was very he was very optimistic. He was very positive about where Google thinks it's going in the hotel industry. And he did not say this, but reading between the lines, Google is going to be a force in the hotel industry no matter what, and probably not in the not too distant future. So that'll be interesting to watch.
Well, maybe some competition among the OTAs will be good for hotel owners.
Well, that's right. That's right. But still, at the end of the day, everybody likes to bash OTAs. But at the end of the day, the only way OTAs can do what they do is by getting inventory from hotels themselves. So it's the hotels that are giving them the inventory, the ammunition, if you will, to charge the rates, the commissions that they're charging. So,
right.
Again, it's kind of a capitalistic way of looking at things, but if you don't want them to make that much money off you, don't give them your product.
That's right.
A simplified way of looking at it. You can see big data, big brother. Will hotel guests rebel, or have they accepted the fact that when, as a loyalty club member, when they use their credit card, when they sign on to the hotel internet connection, all that data, where they're going, what they're doing is being collected. The question is at what point are consumers going to say is enough, or have we just reached a point where people think, hey, George Orwell was right when he wrote 1984, and when most of us read that in college or high school, we kind of looked at that and said, that's kind of far out there. Well, 30 years, 40 years later for some of us, it's not that far out there. So it'll be interesting to see that. Now the next point, I gave these slides to Glenda yesterday afternoon, and we didn't have time to update them this morning. For those of you who have been tuned in or not tuned in, Hilton announced its IPO. They filed for their IPO last night. A holding place number of $1.25 billion. That will certainly grow. I mean, Blackstone bought Hilton in 2007 for $26 billion.
Yeah.
In the filing, Blackstone made it clear that they intend to remain the majority owner of Hilton. Mm-hmm. So, what that price will be, I've heard estimates ranging from $40 to $60 a share when the IPO ultimately does go public, probably sometime in the first quarter of next year. The big question is, I'm talking to people on the phone all morning, the questions that are still out there, will this be an IPO for the company as a whole, or will they split off different brands? Will they split operating, management versus franchise,
Right.
and then ultimately it comes down to what management team, what leadership team is going to lead the company once it is publicly traded. And pretty much the people that I've talked to today, the consensus has been they don't envision the management team changing at all, really, because Blackstone, people will buy the shares based on the management team, what they've created, the historical value, et cetera. So that team should stay intact. Is the
if Blackstone wants to remain the majority stockholder, obviously they want to keep control. So they'll still be the major factor, I guess, making decisions on who's heading it up.
That's right. And then the third question, which is starting to simmer as well, is okay. So Blackstone is going to, let's face it, make a ton of money from this IPO. Who knows how much? But what are they going to do with the proceeds from that? They're a big hotel owner. Because they're private, I've never been privy to seeing an entire list of all of their hotel holdings. They own a lot of individual properties, a lot of luxury properties. They own right now. They own ESA, La Quinta, Extended Stay America, La Quinta, Hilton. That's a pretty big portfolio right there.
It is.
So what are they going to do with the proceeds? That'll be interesting to find out. I thought La Quinta would go public first and then Hilton, but it looks like Hilton's going to go, and then La Quinta will. I have to believe La Quinta will follow at some point, or Blackstone has some sort of exit strategy for La Quinta, whether it's public or selling the brand outright. But I believe their hold time is probably nearing an end for that. Obamacare is still a big concern for hotel owners, and how does it affect values of hotels when you really don't know what the total cost is going to be? I would suspect some of your members, the HBI members, have come across this, but I've talked to owners who said, we were into it, we thought we had it done, we went over it with a fine-tooth comb, what we thought the costs were going to be, and then we found a $60 per employee charge that we previously hadn't been privy to, so now all of a sudden that goes up. So how does a cap rate get set? How does a value get set when there's this moving target of what your operations costs are going to be? So, that's a big concern for a lot of owners as well. And lots of room to grow. Most conferences I attend, and I attend a lot of them, the general consensus seems to be that 2018 will kind of be where the industry peaks, and then we'll start going into the down cycle. So if that is indeed the case, and we still have 4 solid years for the hotel industry to prosper, so it should be a good run. And of course, there's always the caveat of saying, barring any unforeseen black swan event. If we go to war in Syria, what effect will that have on gas prices, and then the trickle-down effect there? Or, if there's another attack, God forbid, somewhere. So that black swan event is always the wild card in there. But by and large, everyone that I talk to is very optimistic, with just a little bit of hint of cautiousness that, so that I think they're kind of protecting themselves, especially those who went through the tech bubble in the late 90s, and then, the frenzy of 2006 and 2007. I think people have been through those because the cycles, and I'll show you this in a few minutes with data, the cycles are starting to get much closer and much more volatile, so I think naturally people get a little more guarded. And I think that's a classic case of what's going on now. Hey, I'm not going to put all my cards on the table right now. I'm going to keep a couple on the side just in case.
Right.
So I thought I'd start off with the investments in review, and again, thanks to HBI for the participation with STR Analytics located out in our Boulder office. Steve Hennis heads up that effort. to look at a few of the investment trends that we have. You can see these are hotel investments from January 2012 through August 2013. So you can see that acquisitions in general are outpacing development investments 2 to 1 or thereabouts. So you can definitely see where the money is being spent, which is good news for HPI members, of course.
Right. For selling existing hotels, yeah, it's a good time. There's more development of new product than you might think, but I think a lot of that's been in some very, specific markets, the larger markets, as far as the new development.
That's right, and we have some slides about that a little bit later on. So certainly, it's while we certainly want the volume to be up, it's certainly a good environment for acquisitions right now. So we're looking at here the transaction volume, the projected volume for 2013. We're pegging at roughly $17 billion, right in that category. You can see that that's up from last year, but it's down from 2011 when all the REITs went on their frenzied buys and drove a lot of that activity. And of course, when you look at like I said, those frothy days of 2006, 2007, it pales in comparison to then when, in 06 when it was over $30 billion in volume. So it's looking up from last year. We'll see if the pace can continue as 2014 unfolds. The capital per key, the hotel, again, the hotel transaction almanac, these are the capital per key, and you can see it's roughly at a little more than 25,000 per key. So the actual number, the volume's up, but the actual size of the transaction looks to be down based on that 40,000 per key last year compared to the 25,000.
So these are prices per key or per room in sale transactions.
I'm sorry, I wasn't clear. This is the additional capital, so what they're looking at for PIPs.
Oh, okay, got it.
Yeah, sorry about that. I wasn't clear on that.
Additional capital. So this is after the price per key of a sale. How much more they're going to put into it? That's right. The average right now is a hair over $25,000 a room. Yeah, still pretty substantial.
Yeah, absolutely. And that just goes back to show the condition of a lot of hotels and how some of them hadn't been renovated since right after in that 2001, 2002. So you're looking at 10 years without capex improvements. So
right,
that's a little scary, right?
It's a lot of carpet then.
So here's the average price per key in 2000. Per year through August 2012. So you can see 100,000, a little under 100,000 was the threshold at the turn of the century, and that has doubled in the 13 years since then. So we're seeing larger transactions in terms of dollars being spent. And then here's your average cap rate. This is it's been kind of up and down during the recession, and cap rates right now are at I suppose a 3-year low compared to what they have been. So, and again, I'm sure your members see this and would love to hear their thoughts on this. What they think the further out trend is going to be. So if anybody wants to share that in the question category of what you're thinking in the question box, you're more than welcome to, just to kind of share your knowledge so everybody can see what you're thinking in terms of cap rate projections for let's call it 2014 and beyond.
Yeah, I think what we're seeing is a range of cap rates based on, and it varies so much because of the condition of the hotel, the local market, the size of the market, the brand, age of the hotel. And even we had one sale, a Country Inn & Suites in New York, Pennsylvania in March, where the appraiser used a higher cap rate, which resulted in a little bit of a ding on the sale price. The appraiser used that higher cap rate. He used a 10% cap rate because a developer had just announced the construction of a Hampton Inn that was going to happen right across the street from that Country Inn & Suites. So cap rates, the appraisers also weigh in when it comes to cap rates, and if they see something in the market that they don't like, then they may use a higher cap rate. But overall, yeah, cap rates I think are coming down, particularly for the more attractive brands, newer hotels, and that's what a lot of the REITs and the active buyers are looking for, that kind of product. And I think that's also a factor in why we're seeing the cap rate go down, is the type of product that's being sold.
Yeah, and as you said, the type of buyer that's out there.
Yeah,
certainly. Yeah. So here's the year-to-date 2020-13, the deals by property class. I won't go through all of these, but you can see it follows logically what you would expect from each of the chain scale segments as STR defines them. I guess that when I looked at this chart, the biggest surprise I had was the difference in the average size of deals between upscale and upper upscale. That's quite a dramatic difference in average size of deal that, don't know why, it just surprised me.
Yeah. I actually, before we go too far away from the cap rate discussion, there is a question from the audience regarding the cap rates. And that is, are you finding cap rates are lower for select service versus full service? First question. Are cap rates lower for select service versus full service?
Yeah, I think the answer to this, and I don't have a slide for this, but I think in general the answer is yes, they are, because the limited service, particularly the select service hotels, are so sought after by more buyers, where the full service boxes, particularly those in suburban markets, tend to be, in some people's minds, they tend to be more obsolete because you have so much meeting space, so much retail space that you can't utilize, and you can't rent or lease. So yes, I think in general the cap rates for limited service, select service are lower than full service at this stage.
Right, and also because cap rate is affected by the PIP, and PIPs on a full service, you simply have more. You've got more square footage you've got to renovate. So, generally the PIP cost is going to be higher on a per key basis because you've got more public space that you've got to take care of. So cap rates may be a little higher on those full service. Also a question, are you seeing cap rates lower in urban or tertiary markets? I would say absolutely lower in basically the bigger the city, the lower the cap rate.
I think everybody wants to be there.
Everybody wants to be in New York, Miami, Los Angeles, San Francisco. Bigger cities also, it follows the average daily rates. Wherever ADR is higher, cap rates will be lower.
Okay, so we'll move on to development. And Charlie, I better double check to make sure that I'm moving at a good pace. Are we good on time? I just want to make sure we're
we're good.
Okay. If anybody wants to give me a heads, sometimes I can drone on, as you know me well.
No, it's all good.
Okay. So we've got the new hotel rooms, that have been added to the supply in the last 13 years, and you can see that they're, as you alluded to earlier, Charlie, with construction being, there's more than you think out there, starting to inch its way up. The good news is that if you look at it all the way back to 2000, it's still only on the level of about 2004. So
right,
the question, and we'll show more slides about this later, but the question will always be, when money loosens to the point where developers can get it a lot more readily, what's that going to do? I mean, I had, we at our hotel data conference last week, we had a panel about buy versus build, and there's a company down in Pensacola called Innisfree Hotels. Great little company, has nice hotels on that, that Pensacola Beach, Fort Walton Beach, right there on the Gulf. And Brooks Moore, their CFO, I think he summed it up best. He said, "Look, if there's money, we're going to develop. If there's not, then we'll look to buy. But we are developers." And I think that's the general mentality for a lot of people. And a lot of these developers are just really itching to develop because they haven't been able to for a number of years, and want to satisfy their urges, I guess, so to speak.
Right.
So
well, if hotel builders aren't building, they're not in business. So they want to keep building. The brands want to keep pushing for more and more and more, and even the cities are always happy, which I think sometimes is short-sighted, but always happy to say, "Oh yeah, sure, build another hotel. We think it's more tax revenue," but there are consequences longer term that to the industry and even the neighborhoods and the communities. But I think for right now, equity requirements are going to remain about where they are, and so money is available, but it takes more equity than it used to.
I think you're right. So, these are just a quick look at 2012 full-year stats by class. I won't take too much time on this chart because the stats are a little bit older based on year-end numbers. So we'll be updating this as 2013 closes too. But you can see, that upper mid-scale, the number of openings, 178. By far the most openings that of any of the
upper upscale, yeah.
So. And then new hotels, but you can see the leaders of the hotels that are being built in the last 18 months or so, from the beginning of 2012 through July of 2013. Hampton Inn, a behemoth in and of itself, continues to aggressively grow. You can see, I think when people look at this, there's a number of people who look at the Best Western Plus and are surprised that by the new construction in that brand, which has typically not been trumpeted. So
right.
I think that tiering system that Best Western introduced, I think 2 or 3 years ago, I think is paying off for them in attracting developers to build at that upper end of the Best Western spectrum.
Yeah, seems like it was a smart move, and yeah, I didn't realize there were that many Best Western Plus new constructions. So interesting.
Yeah. Now, I think the Best Western Plus is in that middle ground. They have a Best Western, a Best Western Plus, and a Best Western Premier. Yeah. So that's kind of in that middle ground that I think owners are finding a comfort level with that tiering system.
Mm-hmm.
So as I said, I'll just give you some quick global numbers. This is our data through the second quarter, so through June, of global occupancy. So we're at about 63% occupancy around the world, which is a pretty robust number. You can see this broken down by the regions that STR defines. So we divide it into 4 regions around the world. Now, that is a very big geographic area for each region, and as everybody on this call knows, that it's a market by market, a street corner by street corner business.
Right,
so,
right.
This is just meant to be a broad view. But look, what we're looking at here is if you look at the green line in Middle East Africa, which really got hit hard by the recession, bounced back. Now it's starting to waver, tail off a little bit. And then if you look at the blue line, which has had that steady decline, but never, so Europe demand never went negative after it rebounded from the initial assault.
Yeah.
Pardon me, of the recession. But now you can see it's starting to inch up. So if you look at the red line, the Americas, and the blue line, Europe, it's at about the same spot in demand, which we think is a pretty good story. It kind of says that, if Europe comes back, if Europe's coming back demand-wise, that, has a residual effect over here as well.
Yeah. Right. Well, I think while the Middle East and Africa had, had a lot of growth potential to absorb, it's certainly the Middle East and North Africa has been greatly impacted by all the, the political upheaval, particularly right now in Egypt. So I think that's responsible for that downtrend of demand there. Although overall, Africa is, I think, going to be on a long-term growth spurt.
Well, it certainly is a continent that all the major brands are looking at. I just saw something was it yesterday or the day before about Nairobi and the interest in developing hotels in Nairobi right now is at an all-time high. So so we'll see a lot more development there, and that certainly will impact the numbers. I think positively, because I think there's probably a lot of demand that's just not being met there at this point.
Yeah.
So looking at this is RevPAR percentage change through June. You can see that everybody's kind of slowing down from previous years, except for you look at Europe again, and I think the title of this slide, I don't know what, maybe that shot of tequila was working or something, because I shouldn't have just put it except for MEA. You're looking at Europe coming back from a 5% RevPAR drop in 12 and 1.9% gain in this year. And then, of course, the MEA having a good year RevPAR-wise, even though their demand is down. So you can tell that it's starting they're starting to drive some rate there, and it's affecting RevPAR. So now we'll turn our attention to the U.S. These are numbers through July. They're our latest numbers that are available. We're actually going to crunch August numbers early next week. So for the first 7 months of the year, the highest RevPAR ever. You can see the asterisk by every one except occupancy. This is at an all-time high for room supply, demand, ADR, RevPAR, and room revenue. So, yeah, it's a pretty good time in the hotel industry right now. And the big question, as I alluded to early on, is that 4% gain in ADR at this point. I think most hotel owners and operators would like to see that higher, because the fundamentals are still in place to be able to drive that. But there seems to be just a little bit of fear among operators to actually aggressively grow that.
Yeah.
So here, like I said, in July alone, the highest monthly room revenue ever at $12.2 billion. That's not a total shock, because July, as you would imagine, every year is the biggest month of the year because of all the family vacations and travel going on. But for it to be the biggest month ever, I think tells a great story of where we're at in the U.S. hotel industry. Again, things are pretty good. It's a good time to be involved in the industry. We do see a favorable supply and demand equation right now, but you can see the red, which represents demand, has been declining. It's still positive, so it's still good, but it's just not as good. And then you can see the supply, where it peaked there in 08, 09, and even into 10, where all those projects that were put into play in 06 and 07 finally opened, and then had the big drop. But now we're starting to see the yellow line creep up a little bit. So it's favorable, but it still bears watching. And you can see this chart where the ADR percentage change and the occupancy percentage change. So occupancy is starting to go down, and a slight concern is the fact that that ADR percentage change has really kind of leveled off. So it dropped way down 9.7 there in the peak of the trough. I guess peak of the trough is the wrong way to put it. In the depth of the trough, and rebounded fairly quickly, but it really has kind of just leveled off at 4%. Now, 4% is not too shabby. So, I think most hotel owners would say that's okay in a normal year, but we still haven't gained back the what we lost in the recession. And again, there'll be another slide coming up for that. And here it is. So if you look at 2008, where the nominal ADR was about $107, if it had grown by inflation, strictly by inflation, we should be at $119 next year. Now we are forecasting that we'll be at 116, so we're still well short of growth had ADR grown by inflation only. The good news is the gap is starting to close, but what happens? How long will it take to actually cross that line? And when we get there, are we at the peak, and then we start the decline again, and what happens then? So it will be interesting to watch over the next few years how those lines intersect. So RevPAR, again, the same story. It's not as good as it has been, but it's still not bad. If you look at this is quarterly RevPAR change for the last three years. So Q1, it has steadily declined over the last 3 years. Q2, it had a fairly significant decrease. Same thing with Q3 last year. So if we have another decrease in Q3, what's that going to look like? Are we going to be looking at quarterly RevPAR growth of 2 to 3%? And is that going to be enough to keep owners happy?
Yeah, I wonder if there's been any study or look at correlation of RevPAR growth or decline mapped geographically to new development. It'd be interesting to see if new development is in markets that are just growing rapidly, or if the new development is having a negative impact on RevPAR growth.
Yeah, that's an interesting question, Charlie.
Probably not one you had a ready answer for, I know.
Well, I don't think I've ever seen that map, but I'm making a note right now to see if that's something that so RevPAR growth and decline mapped against
new development.
Yeah, that's interesting. I'll ask around on that and see what we have.
Put a slide together for the lodging conference, maybe.
Well, yeah, that could very well happen. So looking at RevPAR growth, we see it for the foreseeable future. Although it does get a little bit dicey. Remember earlier in the conversation when I said that trough cycles are starting to get closer together and definitely more volatile. So if you look at this chart, you can see RevPAR change, percentage change after the downturn in 1991. We had 112 consecutive months of RevPAR percent growth. Okay, then we hit 9/11 and the downturn. Then we started coming back, and then we had 65 months. Okay, so now we're at 34 months. And how will that play out? Because, again, as you can see by this chart and the previous ones, the green line's starting to go down. Now, there's still significant distance before it dips below zero. But, we do see it for barring a black swan event, we do see RevPAR growth sustaining most likely to the same levels as it has occurred after the 01 and 02 downturn. We're going to look a little bit at customer segmentation, transient and group. You can see the transient demand, and I'm going to go back for 1 second. So for those of you that don't know, can look at the definitions: transient, third-party rack rate, government rate, single business, traveler, and leisure, and group is blocks of 10 or more. So you can see that the green line, which is 2013 transient business, is just gangbusters, up. It's a great story. And if you look at 2007, which a lot of people think is the peak year in the industry, and how much of a dramatic difference there is between the transient demand of 2013 versus 2007, that's a feel-good slide. There's a lot of positive vibes in there. And then ADR finally back over 2007 levels, and again, you can start to see that the trajectory of that green line is very positive. So a lot of good stuff, a lot of good feelings about that. But then we get into group rooms, and you can see green.
Wow.
It's just not there. Even below last year.
You said at the Smith Travel Research Data Conference, I think you said Mitch Shaw of Noble Investments said he didn't think group business was coming back to a level where it was prior to the crash in 2008. Is there any thinking about why group demand is not coming back?
Yeah, there are several thinkings. Now, part of it is the government sequestration. That has had some effect on it. And another big impact on it is that with the advent of the Internet, more people are booking outside of that group block. So they're not booking through, the convention site to get the room. They may be going to the hotel site or to the hotel next door. You're getting a cheaper rate and doing it that way. So we don't know how much we can't measure the leakage to that because the data that we collect just does not indicate that. But we believe that there is that effect. So at the very least, we feel like that effect should, if you were to take that away, we would at least be level. So it's an interesting paradigm shift that's going on. So you can see again, group ADR is it's still gaining momentum, even though month by month it's going down. That's based on the number of conventions in July are far and few between compared to what they are in March and April. So the competition, but it's still ahead of 2008, 2012, 2013 levels. So there is the silver lining in it. If you look, I'm going to go back one slide to the group sold. It's lagging, but we're able to get a better price for those rooms that we are selling. So that's a good room. That's a positive sign that revenue managers are starting to hold the line a little bit more when it comes to group rates. We'll look at some of the key markets in the U.S. You can see this is the slide that looks at the top 25 markets minus Las Vegas. We do not have Las Vegas numbers because of of how the casinos would skew the numbers based on comps and all of that. So we look at all of the top 25 markets outside of that. So from peak, trough to recovery, San Francisco, for example, when it was at its peak, when it hit its trough and then came back, was 37 months. So it hit its peak number sometime there in the fourth quarter of 2011. If you look at the orange, those are the ones that are still, these are estimated, but we're still looking at some that, Norfolk, Phoenix, Washington, that have not even reached their pre-recession numbers yet. So there's still some recovery to go to get back to peak numbers. So, tough road to hoe for some of them. And then peak ADR is still off peak for some. Here's this is the number that I think shocks the most people, because we hear how good New York is, but look at the very far right of this slide. I mean, from the peak ADR to now, they're still down $26.50, even though they've been running high occupancies. So
now there has been some development in New York. Do you think also that maybe there's some, because if this averages across all the chain scales, could it be that there are just more mid-market, or economy even hotels in the city?
Yeah, absolutely. That's a huge factor in this. The supply that has been added and the supply that's going to be added. I'll reference that in a few minutes, but that's it's predominantly in that mid-market, which of course drops the ADR.
Right. There's not too many
ADR.
luxury hotels being built.
That's right. That's right.
Everybody's building upscale, maybe upper upscale, but not luxury.
That's right. That's right. Well, there's a lot of upper mid-scale, a lot of Hampton, Garden Inn, Fairfield, that grouping, Courtyards. So there's a lot of that aren't going to command that $500 a night rate.
Right.
And therefore, anybody on the line here that went to New York in 2006, 2007, I remember going to the Garden Inn there on 8th Avenue and literally paying $500 a night for a Garden Inn.
Yeah.
So with that added supply certainly has an impact on this. If you look at the other end of the spectrum, San Francisco, in the continental U.S. is going great, and New Orleans, the hotel revenue managers there have been able to really maximize that. Of course, in 2008, remember that they were still feeling the effects of Katrina. So there's a lot of that built into New Orleans as well. Pardon me. So we talked about transient versus group again. The percentage of demand change for each of those, group being purple. So we're still not there yet, but look at the transient demand is still, it's up almost 25% in 2013 from the peak. So, again, there's a lot of good going on in the hotel industry. Looking at some of the best and worst markets RevPAR-wise, and I just want to make note that this is data that's through June, not July. So I wanted to just put that caveat out there. You can see some of the, I won't read them all, but you can see these are the tracks that STR covers. I think there's 190 various tracks that we cover, and you can see the performance of some of them, good and bad. What surprises me is the North Dakota one, because we hear about all that fracking, and the RevPAR percent change up there has dropped. But what's the phenomena there is that there has been supply added up there, and they've been very creative in adding some non-hotel supply that's temporary, that house these workers that eventually can be trucked away when the fracking slows down. So just some interesting markets there. Who would think Jackson, Mississippi up 15%? I just kind of wonder what's going on there, and I don't know that. If anybody from Jackson can tell us, tell me. I'd be grateful. Now let's look at the same thing with ADR, and we were talking about fracking and oil. Look at Texas West. That's a hotbed of that. So ADR is up 12%, in large part due to to the oil industry over there. Right,
shale oil there.
Of course, Yep. And then when you look at Indianapolis being down 5.5% in ADR this year, the direct correlation to hosting the Super Bowl last year is a major factor. In that. So, and the good news is that when you look at the worst markets in ADR growth, really there's only 1, 2, 3, 4, 5, 6. There's 8 markets with negative ADR. Everybody else is positive. So that's a great, a great thing to have happen for the industry as a whole.
So the Indianapolis Colts have to win the Super Bowl this year, huh? Or play in it anyway.
Well, they're going to host it.
That's big time wishful thinking for Indianapolis, but.
Well, they're not bad, but remember the Super Bowl this year in February is going to be played in New York. So what's that going to do to room rates?
Yeah, really.
We'll see. This slide is just really, I think people look at that, and this is the RevPAR recovery for the U.S. Off of peak RevPAR. So you can kind of hone in on your region and see where there's still growth to go to get back to that peak RevPAR number. And there's a lot of areas.
So sorry, what's the color? The darker the red,
the bigger the dip. The darker the green, the bigger the gain.
Okay.
So it's interesting. To me, the Southeast United States is. I look at where I'm at in Ohio and Cleveland. We actually have some dark green, something good to talk about.
Yeah.
Lord knows it's not the Browns. So,
Right.
So we'll move on here. I wanted to compare. I'll go through these fairly quickly, but some convention city comparables. These are the cities that do attract a lot of conventions, and it kind of is counter to what we were talking about with the group rates. Particularly with occupancy, where all of these cities are above 60%. So the groups are out there; they're moving around. Houston, the occupancy again just kind of presented a little bit differently. But look at Houston and the oil industry and how strong that is going, and then you look at DC down there where there's a lot of government business. Not as strong.
Yeah.
Looking at the rate leader, Washington, where the business isn't as strong, is still able to command a pretty high rate. And this yellow Indianapolis line, I guess I was still thinking Super Bowl, it's football season. I can't get over it, so I want to highlight that. That's the only reason why it's highlighted. There's still no other.
Well, that's what I thought when with the previous slide with Baltimore being down. I was thinking, well, maybe it's down because after the Super Bowl last year with the Ravens winning the Super Bowl. But it depends on the timing of this, I guess.
Well, and then that really wouldn't affect it, Charlie, because it's the city that the Super Bowl's played in that really has a great effect. Not necessarily the Super Bowl winner.
Right.
So we'll jump through here. Most of these cities are seeing 2 to 7% rate growth. You see Indianapolis drop there again because of the Super Bowl. There's not the demand still. Looking at pipeline, this is a slide that kind of goes back to what you were talking about, Charlie. 23% more rooms in the construction stage this year than last year nationwide. Up overall, the active pipeline is up 9%. So you can see 328 hotels are now in the active pipeline, which is a little bit concerning, I think, but it's not overwhelming. Some markets keep building. We're talking New York. Look at the number of rooms in New York in construction.
Yeah.
Well, and 11% increase in supply.
And being in Ohio, and we see it in Pennsylvania, and we talked about East or West Texas and North Dakota, where the oil and gas business is going crazy. There's new construction in those areas, and those are not the cities that actually the major markets that you've got here, because most of it is in smaller markets. But I know there's new construction in those wet gas areas, the Utica Shale, not as much as the Marcellus Shale now, but I think that may be part of the new construction.
Yeah, absolutely. But on a concentrated, just large number affecting the overall number, those top 25 markets that are leading the way definitely shift the scales.
Yeah,
you can see what rooms are under construction, or what the rooms in each segment. So the upscale and upper mid-scale are the most active, which I don't think surprises really anyone. The big boxes, those hotels that we were talking about with 50,000 square feet of meeting space, you can see in 2008, 12 of them opened in the U.S. As of last year, none, and as of July of this year, 0. However, that will change when the Omni opens in Nashville, so there will be 1. And I think that's scheduled to open sometime in the next month or two.
Yeah, yeah.
And then on the other hand, these are the rooms and number of hotels that have closed over the years. So you can see the hotels on the left, rooms on the right. Look back at 2005. That, of course, is Katrina related. So the number went down, down, down. 2010, very limited number. Went up in 11 and 12. It was, slightly, significantly lower than 13. So we'll be eager to see at the end of the day what happens in 2013.
Yeah, yeah.
But the conversions stay pretty stable. If you look at the white line that goes across, that's the long-term average. About 4.2% of the total rooms in the U.S. industry get converted to a different flag every year. And 2012, we were right at that long-term number. 2013, we're seeing it uptick slightly, so we think it'll come in somewhere around that 4.5%. Total rooms, so nothing dramatic there. But the conversion growth does counter supply growth. You can see supply in yellow. So when supply growth goes down, conversion growth goes up. No, I don't think anybody on this call is shocked at that, but this kind of gives a good visual for that.
Yeah, yeah.
Going to look at projections. How we see the world shaping up over the next 3 months for this year, and then into 2014, you can see our supply and demand forecast, where we project demand to grow about 2.25% this year and 2.5% next year, and supply to still be fairly muted at around that 1%. So even though there's the number of rooms under construction is growing a little bit, it's still at that 1% or so growth, which is a good sign. When it starts getting to 1.5%, 2%, that's when I think everybody will start going, whoa, what's going on here?
Yeah, yeah.
This is the occupancy percent change. Again, you can see the 20-year average with the yellow line at 0.04% down. So typically every year we lose a little bit of occupancy over the last 20 years, but you can see since 2010 it's gained. Now, of course, a lot of that has to do with that big old minus 8.8. Those two, as my golf score indicates, those two snowmen hanging down there, minus 8.8. That's a lot to recover from. So it's no shock that occupancy is up. But it is starting to wane. So you can see our forecast there at roughly 1.4, 1.3% the next 2 years.
Yeah.
So this is actually the total occupancy in the U.S. You can see we're projecting next year to be 63.1%, which is actually a higher occupancy than it was in the peak in 2007. So, again, that demand has just been robust. It's grown over the past 5 years, and we're seeing record numbers. And this number, our projection for next year's occupancy really bears that out.
Yeah, well, that's cool. Great news for the hotel industry overall.
That's right. So here's the ADR percentage growth. Again, you can see the 20-year average at about 3%. We're significantly higher than that the last 2 years. We project it to be 4.2% next year and 4.6%. 4.6% next year, 4.2 this year. Interesting thing, at the data conference last week, we had a panel, the closing general session, where we presented all of this data, and we also had PricewaterhouseCoopers and PKF on stage. So the three companies, everybody projected 4.2% ADR growth for this year. I think this is the first time I've ever seen all three of those companies on the same page. So it better grow 4.2% overall.
Right. Yeah.
So here's the actual projection for the actual number for ADR. Next year we think it's going to be almost $116 a room. Again, we know it's a street corner business, and some street corners don't touch that number. But overall, we'll reach a record high for ADR this year, and then we'll surpass that next year. RevPAR percentage, we still project very robust growth, about twice as much as what the industry average has been over the last 20 years. But again, you look at that, just the elephant in the room is that minus 16.7 in 2009. There's a lot to recover from. That year by far was the biggest drop ever in the industry as we know it, and we're starting to get there. It's taken a while, but we're getting there. Looking at the key metrics for 2013 and 2014, we just went over them, but this kind of puts them into that snapshot form. And looking at it by chain scale, again, I won't read all of these, but in general, we see ADR. No shock that the upper end will see the more robust growth, and then that's good because the trickle-down effect. The better the luxury end performs, then everybody else can kind of fill in their appropriate spot on the ladder. So that's
it's interesting that economy looks like it's even doing better than mid-scale. Mid-scale seems to be the lowest on, at least as far as RevPAR.
Yeah, mid-scale, it changed dramatically when Best Western went with the tiering system, because the Plus and Premier, I think, went up to upper mid-scale based on their ADRs. So how do I put this tactfully? I mean, at mid-scale, it's still a strong segment, but the product there tends to be a little bit older. Just tends to be a little bit older, and therefore has its own challenges in itself.
Right. Well, very diplomatic, Jeff.
Thank you. And then here we're looking at the same chain scales for 2014, and the same phenomenon takes place, including the mid-scale being a little bit lagging the economy. But in all fairness, a 4.5% RevPAR growth, for a mid-scale property, that's not bad.
Nothing to sneeze at.
No. I think a lot of those owners will be, would be happy to have that. And then just kind of, this is what goes, some of the things that go into our consideration for our forecast. I won't dwell on it, but you can see some positive things there. The one I like to look at are the corporate profits. There's still a lot of profits being taken, and then the bottom one, the unemployment rate forecast is to get in the neighborhood of 7%, and that can only be good if that continues to drop. Yeah. And then here's that look again at that room rate slide. I like to kind of start closing up with that, because I think people look at that and go, there's still a lot of room to grow. But when you really compare the projection for record ADR this year and next, there's a lot to look forward to. Total U.S. RevPAR versus inflation. You can see RevPAR. Well, I'm going to go back one slide. So this is room rates not caught up to inflation, but RevPAR has. So what would have happened had rates been aggressively grown? RevPAR would have blown it out of the water. So we are now right at the cusp this year. We project next year where RevPAR kind of turns the table and outpaces CPI growth. So again, we have this will be on the Hotel News Now site within the next 45 minutes or an hour. You can download it there, and certainly we can ask any questions. I think, that was it for me. I'll go back and let you take the slides again, Charlie, but I'm happy to answer any questions that you might have.
Well, I do have a question from the audience here, and that is, why has Smith Travel Research discontinued showing in its presentations chain scale year-to-date and trailing 12-month occupancy, ADR and RevPAR percent change and amounts, so comparisons can be made to the forecasts numbers you present? They think it stopped in March or April. So the discontinuing of chain scale year-to-date and trailing 12-month occupancy, ADR, and RevPAR.
I'm making a note of that because I'm totally honest, I don't know. I am not aware of any concerted effort to do that. Perhaps it, it
just wasn't a slide that was put in the presentations.
Yeah, and if it's happened, I'm making a note. So discontinuing chain scale year to date, trailing 12.
And trailing 12 months occupancy, ADR, RevPAR.
Yeah, I don't. I honestly don't know the answer to that. I mean, I can. Perhaps the presentations. As we continue to dig deeper in our data, we're trying to present different data that than we historically have done to appeal to more people. But that's certainly something that I'll ask about.
Yeah. Well, obviously, from an astute follower of your data.
Well, I'm glad to hear that people are using it that way because that's job security, right? So
yeah, right. They're looking for it. It's important.
In all seriousness, I'll raise that question among the senior management team to find out if there's been a concerted effort or not. And Charlie, if you want to take that person's name and number, I can or name and email address, I can tell you what the answer is, and you can forward it on, or I can forward it to them, whatever. But I will.
Yeah, I don't get that through the Bright Talk presentation, but if whoever submitted the question wants to email me, they can email to me at charlie@mbahotels.com. But that was a wealth of data, Jeff. We appreciate it from the data experts at Smith Travel Research and Hotel News Now. And we appreciate your relationship with Hotel Brokers International. I'd like to remind the webcast viewers, don't forget to rate today's webcast by clicking on Rate, which is found on the gray bar located at the top of the webcast player. You can download a PDF of today's featured hotel listings plus a selection of additional hotel investment assets listed by Hotel Brokers International under the Attachments button on the top of the webcast player. As a reminder, this and previous Hotel Investors Marketplace webcasts are also available on demand, viewing online at hbihotels.com. HBI will be exhibiting at the Lodging Conference being held in Phoenix September 17th to 20th. That's next week, and I know Smith Travel Research will be there. I will see you there, Jeff. HBI is also a supporter of the Hotel Investment Conference Europe being held in London just after the Lodging Conference, September 24th to 25th for the Hotel Investment Conference Europe in London. HBI will also exhibit at the Best Western International Trade Show being held in San Antonio on October 17th and 19th. HBI brokers look forward to seeing you in the next marketplace. Again, thank you, Jeff Higley, Smith Travel Research and Hotel News Now. Have a great day.
Thank you, Charlie. Thank you.
Thanks, Jeff. Bye-bye. And this ends our broadcast.